Welcome people to my new video. Apologize for my bad English. In this video I want to talk about automated trading, automated trading, or again translated to gambling, automated gambling. So there are a lot of synonyms for automated trading, algorithmic trading, robot trading, trading robots, program trading, mechanical trading, systematic trading, high frequency trading, low latency trading, ultra low latency trading, black box trading, trading models, quant trading. So of course, what is automated trading? Well, it's or gambling. It's trading of securities or gambling based strictly on buy-sell decisions of computer algorithms. Trading of securities, in this case, let's say gambling, based strictly on means that it's predetermined. So it's not like, oh, one time I do this and another time I will do this and I have no idea what I will do. No, it's based strictly on, so it's predetermined. So buy-sell decisions, of course with gambling, you're not really buying and selling, so it's not like you buy red and later sell red. But, so there are some similarities. It's not completely the same, but there are similarities. Now, decisions are always based on something. Here, it can be based on technical analysis, fundamental analysis, sentiment analysis. Now, this is technical analysis, and you see the price movement. And here, okay, the company is not important. And this can be, Coca-Cola, this can be, Bitcoin, this can be Evolution Gaming, right? So the stock price, it doesn't matter. You try to detect, patterns and right, with moving averages, with charts, with indicators, and these technical indicators and oscillators and so on. With fundamental analysis, the company is important. So you get all these financial ratios, liquidity, solvability, profitability. Again, so it's a computer, so automated gambling, our trading. So it's a computer program which will follow a defined set of instructions, right? So do this, this, and that, right? To place a trade or to place a gambling bet. Remember, computer algorithm, and a computer algorithm is well-defined computational procedure. And there's always an input and an output. For example, the input is, oh, there are 3 reds, so the output then says I need to place 1 bet on black. And of course, it all starts with, so it's basically about strategies, tactics that you will have to backtest against historical data. And for this, you of course need to design and program a computer algorithm. So here you see, what product do you want to trade? I want to gamble. What is your strategy? So strategy is always general. On which exchange do you want to trade? So let's say I stick to Evolution Gaming or Playtech or right. Work on the algorithm, and then of course backtest your algorithm. Then put in production, and then later refine the algorithm and make some adjustments and try to improve your algorithm. And guys, of course, it's more complicated than this, but this is basically the basic structure of an automated trading system and an automated gambling system. You always have an alpha model, risk model, transaction cost model, portfolio management model, and execution model. And you all need to program this, right? So here you have the data, there's a new daily bar, or in other words, there's a new spin. And let's say, yes, there's a new spin. And it goes to the risk model. So the risk model then will ask, do you have an open position? Let's say the answer is no. And did the system, and the trading system, your automated gambling system, already started a gambling session? So let's say the answer is no. And then it goes to the alpha model. Does this alpha model generate a signal? Do you get a signal to can start a gambling session? So let's say no, right? And it goes back to the new spin, no, no, right? The new spin, no, a new spin, and then bang, yes, the alpha model generated now a signal. So it goes back to the risk model. Then the next question is the trade valid? And maybe you're playing multiple wheels simultaneously and there's a signal, but there is not, the trade is not valid, and because of your portfolio. But let's say it's yes, and then it goes to the execution model, and fill and execute. The automated gambling system will really place the bet. So you are not placing the bet, it's the automated gambling system. Right? So yes, and the position management model, we will look at the result. Will you so you place a bet, and then it depends. You win or lose. Let's say is the condition valid? So let's say you lose, but you still did not reach the condition. Let's say your stop loss. So is the condition valid to keep on going? Yes. So the next spin, right? You have already an open position now. Yes. Is the condition, and you place a bet, is the condition valid? Let's say it's now no, and you reach your stop loss. So the condition is not valid anymore. So then the system will close the position. That remember I've talked about the alpha models, and you need an alpha model. Now synonyms for alpha models is like forecasts, factors, estimators, predictors, alphas. So an alpha model, you need an alpha model, and an alpha model needs to tries to predict the future well enough. And so an alpha model then creates a signal. Remember, I've also talked about you need a risk model. So this is all about risk. How many risks are you willing to take? Some people like a high reward but high risk strategy, like Dante, Washington and so on. Some people want a safe strategy, but low steady returns. I'm more this type of gambler. So risk models have to do with, position size limiting, risk reward ratios, like the Sharpe ratio and so on. Stop loss, what's your stop loss, right? Then again, you have the execution model, filling the trading orders, sending them to the broker to execute them. And with the position management model, remember conditions. Are the conditions still valid or not? Did you reach your stop loss? Or you reach your daily profit or your profit goal? Then it also will close the position, right? So there are, conditions that you programmed. And of course, guys, it's all about strategies and tactics. And you, of course, need to find a good strategy. And there are basically two strategies. So you have mean-reverting strategies, and you believe in a counter trend, or momentum strategies, and you believe in trend. Right? So mean-reverting strategies versus momentum strategies. So you see here the green, that's what we theoretically expect, and that's the mean. For example, in roulette, 100 spins without zero, red, black, 50-50. But red was practically, red fell systematically more than black, let's say 62%. Then some people believe that black will trend, right? So there's a counter trend. It will come back to the mean. It will revert to the mean. Then you have momentum strategies. Some people believe, okay, it was a lot of red, and it is a trend, and they detect a trend, and they think that the trend will continue. Let's say you have 10 strategies which work, but one will perform better than the other one, right? And that's why we need these ratios, and they give us information about this. Information ratio, Sharpe ratio, the Sortino ratio, Trainer, Kalmar. And this, guys, is now very important. Backtest. You need to test your strategies, your tactics. That's that's the in-sample test. And how to backtest your trading strategy, or how to backtest your gambling strategy. So the backtest, now you apply your algorithm to historical data, right? So this is the known data, the training data set. And then at the end, we will check the accumulated revenue and the accumulated cost. And of course, the accumulated revenue minus the accumulated cost will give you the net result. And you will profit with this strategy, with this algorithm, or not, or you will lose. Why do we do a backtest? Because of reasons of filtration. And so we try to eliminate the bad strategies. Here, garbage, it's not working, so buy, right? Verification, because there are a lot of certified bullshit talkers on YouTube, and a lot of people claim that their strategy work, and then that's verification. Optimization, so modification. This means, let's say your strategy works, but maybe if we make some adjustments, we can improve our strategy, improve our algorithm. There are two types actually of backtesters. So you have research backtesters, that's more theoretically, and that's the first thing we actually do. It's the most simple one. And then and after this you have to do event-driven backtesters, right? So that's the second one, and that's more complicated. And then of course you get all the results from your backtest, right? Let's say it works, and then you will apply this to unknown data, future roulette spins. That's the validation dataset. And this performance can diverge from your expectations. Some reasons for this is like bugs in your automated trading system software, data snooping bias, survivorship bias. Another reason is regime shift, physical disaster, Another reason still can be just bad luck. And this, guys, is very interesting. So I want to explain what is data snooping bias. I will also call this curve fitting optimization bias. So when you backtest your strategy or algorithm to historical data, you know the data, right? You're aware of the data. So this is this green line. I will visualize it like this. This is the green line, the reality. So the known data, the historical data. And your algorithm performs like this, the blue line. And it's pretty close to the reality. So now you think, oh, I will adjust some parameters, and maybe I will change my entry point, my exit point, or maybe I will change the bet levels, right? So you make some adjustments, right? And the blue line comes more and more close to the green line. But you did not, this is just curve fitting. You did not create a better prediction tool. So assume for a while that you can't see with your eyes the green line, and so that you don't know the historical data. You cannot see this green line. And I ask you now, make adjustments of parameters in such a way that the blue line is now closer to the green line. But you do not see, and you can't see the green line. So you have no idea which adjustments you have to make. And that's an example of this. Let's say these are spin results and roulette spins, black, 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 red. You bet red with some kind of bet levels system, right? So 1, 2, 3, 4, 5, 6, 7 here, and so you lose at minus 14. So because you know the historical data, you will say, you know what, if I change this 7 to 22, hey, then I'll win. But this is curve fitting. It's also cool to really visualize things with heat maps. Let's see, like here, sharp ratio heat map. Here the z-score. Here, let's say here was my entry point, and here was my exit point, and then this creates this sharp ratio. But maybe if I waited a little longer, then I see, hey, my sharp ratio, I improved my sharp ratio, right? So it's really cool to visualize things. And then, yeah, you have the levels of automation, and you will automate just a few things, or you will automate like everything. So here, so the level of discretionary trading, if the level of discretionary trading is high, then the ability to turn it into an automated system is low. Level of discretionary trading is low, then the ability to turn it into an automated system is high, like roulette. And here, you need contextual information, individual interpretation. But here, roulette is a pure mechanical system. You don't need, all this information. What will happen if Russia attacks again, Ukraine, or what will happen between America and China, or what happens if the inflation increases or the unemployment rate increases. Here, somebody just picks up the ball, throws the ball, picks up the ball, throws the ball, picks up the ball, throws the ball, right? So roulette is a purely mechanical system, and that's why automated systems and algorithms work so well. And then, of course, levels of automation, it depends, of course, on you, on your time, on your programming skills, your capital, your goals, and you can hire a programmer, but this of course is expensive and will cost you money, so that's a transaction cost. Here, this in red is the program language itself, so like C++, Java, Python, R, MATLAB. So this all has to do with strategy, complexity, customization, how flexible are they, bias minimization, and so with some programming languages create have a data set with more biases than the other, and blah blah blah, right? Then here, then the execution capability. So okay, you can program everything, but can you, is there an interaction or integration possible with your casino or with evolution game and with the platform? And so the execution capability, and maybe it's not possible, right? And even if it's possible, then maybe there's a speed problem, and there's the speed of the execution. This has to do with the latency, so it sends a signal, then you get the signal back, and maybe that's the reason why you get these errors that evolution game rejected your bet. This has to do with latency, and so the speed of the execution. So of course you can program like really everything, and that's a fully automated gambling system. So there are no human errors anymore here, no delays. Of course it's complicated and costly, and maybe it's illegal to do. Or you can just program parts of the process that's semi-automated. It's not complicated, not costly, or less. But of course, here are still human errors, delays, and maybe it's also illegal. Then you have very technical guys about the level of automation. It all starts with your operating system and the hardware. What do you choose? Windows, Mac, Linux, and so on. You need a financial data storage, storage formats, loopback period, query time, data accuracy evaluation. So if there are errors, how to fix it. What about you? You need the backtesting software, an execution system. You choose for local or remote. I/O and bandwidth, compressing data, replication technology. This is very technical stuff. I'm not going into detail here. And then, what are the advantages of an automated gambling system, right? Historical assessment. You can do research and you can backtest things to a large volume of data, right? Second reason is comparison. You can compare current performance versus historical performance. Like this, you get statistical information, and so you can get measurements of risks. Efficiency. Well, there's no monitoring anymore, and you don't need to sit at the computer. So there's no discretionary input also anymore, and no fear, all these human emotions, right? Like there's no fear anymore, no greed, indiscipline, no disposition effect anymore. And higher frequencies. I think it's cool. Automated trading or automated gambling